Hi everyone, I'm Chad Shoop, and in this series, my Bank It or Tank It videos, each week I run through a stock that one of you all recommended. You either left it in the comment box below or posted a comment on Twitter for a company that you wanted me to take a look at. And every week for this year, I'm going to go through one of these companies because I add them to my list. And then lately we've been voting on them on a Twitter poll. And this week, the stock that won was NVIDIA Corporation, ticker NVDA. And a big shout out to Joe Leong for recommending that stock for us to take a look at the other week. Now, because of the volatility that we've been seeing in the stock market, instead of focusing on just the bank it or tank it aspect, where we're looking at the fundamentals, the sentiment, and the technicals to ultimately decide whether or not this is a stock that we want to bank on or tank over the next 12 months. Instead, we're just focusing on stocks that I call my bank it stocks. These are great, solid companies that I expect will be higher 12 months from now. Now, we're not sure where the bottom is. We'll look at the price charts to try to tell us a bit about that. But for now, what I've shifted the focus on in these videos is just on stocks that I would bank on, because stocks after the recent sell-off are trading at a great valuation. Fundamentally speaking, on the price charts, these are great opportunities to jump in, buy stocks on a dip, and eventually benefit as we find a bottom and as stocks continue higher. Now, before we dive into the details on NVIDIA, this week in our poll, I threw in Carnival because these stocks in the cruise lines and the retail, these types of companies that have been just punished down 60, 70, 80% during this quick, just 1 month sell-off, they're looking at like screaming buys at this moment for a lot of people, especially value plays. Many of these companies are going to get bailouts, they're going to get government handouts, they're going to get enough provided to them to where the ships shouldn't be sinking. But it also doesn't mean that it's going to be a V bottom for these stocks. And I don't think that we've seen the bottom for the entire stock market yet, especially these companies that have been severely beaten up, because as we've seen with some of the handouts that are coming out, the airlines are already saying that the $2 trillion stimulus bill that they just passed last week is not going to be enough. Many cruise ships, because they're not listed in the US, may not even get any of the benefits from that package. And then restaurants, they may not even be considered distressed enough when you look at the retail and the airlines and all these other competitors that they're going to be going against, that their businesses are just getting completely obliterated. And that's across the US economy. This is not just, it just hit retail or it just hit airlines. It's hitting multiple industries at the same time, because when you look around, we're all sheltered at home in place. We're all being safe and doing the right things. But as far as the economy goes, it's just completely shut down. And that's the side effect of this. And hopefully it's just short-lived. We'll see the peak level for the virus, and then people will be able to get back to their normal lives, and we'll see the economy come back. But I don't think it's going to be as quick as many expect. That's why I don't think that stocks have ultimately bottomed yet during this sell-off. So even though now's a great opportunity to look at the cruise lines like Carnival, to look at the airlines and the restaurants and some of the retails that you believe will stick around, if you throw all those in a basket and bought as many of them as you can, I'm sure that group of stocks will outperform 12 months from now the rest of the market. That group of stocks is severely beaten down. They'll outperform 12 months from now. But if you're trying to cherry pick and you're trying to pick just a few that you think are going to be the strongest, just buckle up, because there's going to be a lot more volatility, and some of these companies may not make it out to the other side. And now, they don't want these companies to file bankruptcy, so they may have enough safety nets in place to where they'll survive, but their fundamental value will shift so much because all of a sudden they can't do buybacks, they can't do dividends, they can't have certain amounts of CEO pay, so they can't be competitive in the market to bring in the top-notch CEOs and some of the key employees that they already have at the higher levels. They'll leave for places where they can get higher pay. So there'll be a lot of shifts going on, even if some of these companies that are really struggling end up staying in business. 10 months from now, 12 months from now, their companies could look a lot different than they do today. So they may not get back to those recent peaks, which is what you're probably looking at, is what you would want to see the stock jump up to. But if you bought a basket, if you bought as many of as you can, then I think that group would outperform, because some of those are going to come all the way back up. But if your goal is really to invest long term and you're just looking to put some money to work after this sell-off, one of the best places to do it is just a broad market index. The SPY is the one that tracks the S&P 500. That's a great opportunity now to add to that positions, to those broad basket ETFs, because ultimately it's really hard to beat the stock market when you're picking individual stocks and holding over the long term. Because the truth is like those severely beaten down companies, you're not too sure which ones are going to come back to their recent peaks over the next 12 months versus which ones may go bankrupt, and then which ones are just going to continue to flounder here back and forth and not really give you any sort of return. So there's going to be a broad mix, so you got to buy a bunch, and that gets back to just owning the market because you don't know which ones are really going to benefit the most. Instead, your benchmark is the stock market to begin with, so why not just own it? Own the stock market. It's one of the easiest ways to add exposure here. It's what I'm doing in my long-term accounts, just adding to the stock market, not picking and choosing winners and losers, just adding to stocks. Now, if you want to trade it more short-term, then I have you covered with my premium services where we dive in, we pinpoint short-term trades to continue to outperform the stock market, even in the volatility that we've been seeing. We've been snatching gain after gain after gain in these services. So scroll below this video, click read more so you can check out those links to my other services to learn more about how I'm trading this current volatility in the stock market and how you can benefit as well. Now, let's dive into NVIDIA and figure out what's going on with the company today. We're going to start with the fundamentals, and we'd like to take a look at the key stats for net income and net revenues. Now, my key stats, the blue bars are the total revenues, and the key for that is on the right-hand side of the chart. And then the net income is going to be the line graph on the chart, and the key for that is on the left-hand side. So you can see that when we look at a lot of these companies, and NVIDIA is a tech stock, so it's a chip company, technology focused, really driven in the 5G and artificial intelligence, self-driving cars, just high-powered computers, and virtually everywhere that you can imagine powerful chips being needed, NVIDIA is in the space trying to compete for those products. So to see their net income showing a positive, being one of these tech stocks, very driven companies, that's always great to see. We see the dip there in 2020 on their report, and the forward expectations for these stocks are really thrown out the window right now because we know that the shutdown, it's going to hurt even the tech stocks like NVIDIA. Even though data centers are driving growth and they're going to see more demand there, just the broad economies are going to be slowing, and that's going to hurt growth across the board. So we know their 12-month expectations for 2021 are not going to be as good as expected. They're going to be below the bar. The guidance for those has not been updated yet, and a lot of people are waiving their guidance during this earnings quarter that we're just now getting into because there's just so much uncertainty until we get back to normal for them to really gauge where sales are at. But that's why we've seen the sell-off. That's the discount that's already being priced in. But what you like to see is that in a normal environment, they have a really nice growth pattern for revenues, and net income has also followed along. So net income, that's their bottom line. Net revenues, that's their top end sales. That's the money they're bringing in the door. Then after they covered all their costs, paid all their employees, and continue to invest in new projects, new growth, then they still have the net income continuing to grow and showing that it's a profitable company. So these are great to see, and it's one of the reasons that I have NVIDIA as a Bankit stock. So now let's click over and we'll take a look at some of the key competitors that NVIDIA is going up against. So you can see some of these are big stocks just like NVIDIA. We have Intel, that's the giant in the industry with a 237 billion market cap. Texas Instruments, 100 billion, so that's a huge company too. And then we have some of the more growth-oriented ones, Advanced Micro Devices, Micron, Broadcom. These are all less than 100 billion, but they're still solid chip stocks that are worth looking at as a key competitor for NVIDIA, which sits at 157 billion. So it's a pretty large cap stock for the chip sector as we look at some of their key competitors. This is one of the biggest ones. And then short interest, it's as a percent of shares outstanding. It's pretty low across the board. When we look at some of our other ones, they could be 5% or higher. For NVIDIA, it's 1.7% of their shares outstanding, and the average for these companies is 3.9%. So NVIDIA is definitely on the lower end of this, and part of that is because investors know chip stocks that are building the computer chips that go into everything that's helping to advance technology are these companies, the semiconductor stocks, and that's why there's not too much of being bet on the short interest side of things. And then when you look at the price to earnings, they're actually extremely high. 56.9 times earnings for NVIDIA, and the average is 38.2. So this is just a sector that demands a higher price to earnings multiple. And when we get over and we'll look at the revenues and net income in just a moment to compare that. But the bottom line is that investors are willing to pay up for these companies because they know that they are the future and they're seeing the growth rates that you can't find in too many other sectors. So now let's flip over and look at the total revenues and total net income compound annual growth rate over the last 3 years. NVIDIA, 16.5% revenue growth, 18.8% net income growth, and that's well above the mean for revenues That's just 11%. And it's below the net income at 18%. The mean is 25%. So it's kind of middle of the road when it comes to revenues and net income growth. But being a larger cap tech stock in this industry, it's great to see their revenues outpacing. You look at Intel, which is the only other company that was larger than them, and their revenues are only growing at 6.6%, one of the lowest on the board. Meanwhile, their net income, they're focused now on driving profits, Intel is, so they're seeing solid growth in net income. But Nvidia is still driving profits and seeing double-digit growth for revenues. So it's sitting in a great position when it comes to the growth that they've seen. And then a dividend yield, these are semiconductor stocks, so dividends are not really why you would own them. And you can see Nvidia just pays 0.3% for a dividend yield, so it's basically nothing. Some of these other companies, the average ends up being 3.3%. So they actually have dividends that are worth owning the company for. But a lot of these dividend yields, well, they're higher now because of the sell-off. And then these are also some of the older tech stocks. So you look at Texas Instruments and Intel. These are some of the ones that, while they're still in the industry, they're just so broad and so spread out. Again, they're not really the growth companies that they used to be. And now the Nvidia, the Advanced Micro Devices, Micron Technology, these are the growth stocks that investors are focused on today to benefit from, because they're the ones stealing all the new contracts and continuing to stay on the cutting edge of the technological sector. And before we get into the analyst ratings for Nvidia, I just wanted to say that this, being a tech stock and being on the forefront of all these different industries, 5G, artificial intelligence, what goes into self-driving cars, the data centers, the growth in there, they're providing chips for anything you can imagine. And in the midst of this technological revolution where everything's being connected to the internet, including your shoes, everything from your doorbell at home, computers are even more powerful than before, just the ones that you use at home, and trying to get everyday tasks done. Now we need this whole next level of technology in our computers, and these are the stocks that are leading the path. That's why these are some great companies to look to add in your portfolio, and they're going to be the ones that continue to drive growth, whether we go through a recession or not, whether the economy's slumping. As soon as it turns around, these are the stocks that are going to lead the way higher. So they're great to have on your radar, and that's why we're focusing on Nvidia today as a Bankit stock, because these are the companies that you want to be adding to during these massive sell-offs and to continue to own over the coming years. So let's dive in and see what the analyst ratings are for Nvidia. And as you may have expected, but it's rated as an outperform, 1.78, where a buy is a solid 1, sell is a 5. This is out of 37 analysts that S&P Capital IQ tracks in their platform. So we can see we have several dozen analysts covering the stock, which is higher than usual. Some of our companies only have 10 to 12 analysts. This one has 37 analysts covering the stock, and they're almost all in favor, rating it at outperform at 1.78. So that just tells us that the analyst community is really feeling strongly about the stock. They believe, like I've been saying, that it is a stock of the future, that it's going to be around, and that it's one that you want to own in your portfolio today is Nvidia. Now, I always say the best for last, the price chart, because it's my favorite area to look, and it's the one that ultimately gives us our key levels to watch in key areas to maybe look to jump into this position to either add more or reasons to maybe exit. So let's take a look at the price chart and see what we can look at today. We're going to start with a little bit of different look for Nvidia today. This is a chart on a logarithmic scale, which puts the percentage move of the stock even across the board. So a 50% gain at $1 to $1.50 is the same as a 50% gain from $200 to $300, so that you see those symmetrical moves across the chart, and it just helps put in perspective the sell-off that we are recently seeing here in 2020. You can see that this is an older tech stock. It goes back all the way to 1999, and it survived the dot-com bubble. That's what this big crash that we saw, and these are about an 80 to 90% declines for the stock. That's the dot-com crash there in 2002. It survived that, continued to rally. Then it had to go through 2008. This is the global financial crisis, went through a recession. That's another 80% decline for the stock. And then it found its rhythm, continued to drive sales and growth, and it saw an enormous ramp up to get us where we are today. But we also had that correction in 2018. Fourth quarter didn't quite hit a bear market, was very close for the broad stock market. But you can see these high-flying tech stocks like Nvidia just got crushed as we were faced with rising rates, worries over tariffs. It fell 50% during that crash. During the recent crash that we're in now, it's down about 40% at the peak. So we're not seeing the same magnitude of sell-off that we have in the previous crashes, the major crashes that stick to historical calendars and that we're going to be talking about for decades, like the dot-com bubble and the global financial crisis. Even the fourth quarter crash was pretty severe in 2018. But this is the coronavirus, so it's going to be the one that stays on the minds of everybody. And so far, the stock's only down about 40%. Now let's bring it back to a normal chart just to show you why we looked at it a different way. You see now just all you see is the massive run up, and it looks like these are such a severe drop from what the stock has experienced, which once we go to the logarithmic chart, you saw that it really wasn't the case. These are actually pretty mild sell-offs. Now I have a few key lines that I want us to take a look at, but one of the first ones is the 200-day moving average in yellow. We use this a lot of times as a sentiment indicator, but it also helps determine a trend. But for sentiment, we like to see the 200-day moving average trending higher, and the price, which is around $250 a share on last Friday, is being above the 200-day moving average. So right now, price is above it. 200-day moving average is trending higher. So it's a bullish scenario for sentiment based on the 200-day moving average, and it could act as a support level. We see that prices really didn't dip much below the 200-day moving average on the massive sell-off, and even though it may come back and test it, that could be a key support level here around $210, $215 a share, depending on how soon we get that test. But a key level I have up here just to determine the trend, it's a red resistance line, but the important thing to note is that this peak is lower than the more recent peak. So we got the new all-time highs for the company. So that's a bullish reading on the chart, as higher highs indicates that the stock's in an uptrend, and the other part of that is higher lows. So we can see that the low in 2018 from that crash was much lower than where we had a low at with the recent pullback based on the coronavirus. So I have this green line highlighting the two lows on the chart, indicating that it is indeed in an uptrend. So these are very great to see, and this is why this is a stock that I pulled for the Twitter poll, because I love what I'm seeing on its price chart. Even though I don't think stocks have bottomed yet, I think we'll see lower lows. We may not see it in companies like Nvidia. It may not get all the way back down to a lower low, so it could hit support around the 200-day moving average. Then it has this trend line in green that could act as support as well. And then the absolute lowest support that I would be looking at is this one. It's around $150 a share, but it's drawing lines off the previous lows, and we could ultimately fall back to that and still stay in an upwards trend channel, and would make me stay bullish long term on the stock. Now, one of the things that I've also thrown out because of the crash and all the volatility that we're seeing is my price targets. I was getting into a groove of recommending the price target for the stock over the next 12 months, but because of the coronavirus and the uncertainty around it, we really have no clue. We don't know when this is going to bottom yet. I don't think a bottom is in. A lot of people believe that this was the bottom that we just went through last week, but I have a feeling as the wave of negative news hits the stock market and the uncertainty continues to grow about when we're going to get back to normal, as the cases continue to skyrocket over the next week, really. I think over the next 7 days, we're not going to see a slowdown in cases, and that's going to create a lot of uncertainty. And then we're also getting into earnings season. So the guidance on these calls are not really going to be helpful at all. So I think we're going to see stocks roll over one more time at the very least. And that's why I really wouldn't add to Nvidia or look to buy the stock yet. I think you'll have a chance to buy it again under $200 a share. And at that point, you can use this first support line as a indication that you're staying in the uptrend. If that breaks, you may want to get out. Depends on how severe the drop is below it. But I would exit and wait until we test this lower end of the support, maybe below 160. You'll have another chance to get in. And then if that breaks, it's time just to kind of bail on the stock a little bit. It's going to bottom eventually for sure, just like Carnival and some of these other stocks that are just getting completely thrown under the bus. So I don't think that's a likely scenario that it would fall much below this. This would be about a 50% pullback too if it hit around $150. These are the key levels to watch, key areas to keep an eye on. And again, I wouldn't have it listed as a buy unless it falls under $200 a share. So the company is a stock that I would like to bank on over the next 12 months. But I just think that you'll have a better buying opportunity than you do today with the stock around $250. As of Friday, I think this week or in the next couple of weeks, we'll get back around $200 a share, and it gives you that second chance to buy into the long-term rally, and you have the key support areas below you to keep an eye on to let you know when to exit this stock if it continues to sell off. So very quick, I want to run through my checklist that we do every week just to recap the fundamentals, the sentiment in the technicals. So when it came to the fundamentals, the net revenues, net income had a nice trend higher. We know that's going to be disrupted because of the coronavirus and the uncertainty in the market. But I like what we are seeing. We like that it's a stock that has positive net income. It's seeing solid growth in revenues, in net income, double-digit growth for both. So it's on a nice path. So we're going to give it a check mark for the fundamentals. When it came to the sentiment, the analyst community was raving about the stock, had a solid outperform rating, and the 200-day moving average was well below where the stock's currently trading. Both are trending higher. The stock is in an uptrend, so it's going to get a check mark for the sentiment. And then when it came to the technicals, even though I don't recommend buying it yet, the stock is trending higher. It had the higher highs, the higher lows. So as long as those hold up, this is a stock that I would bank on over the next 12 months. I like buying shares or adding to the position under $200, but it's going to be a stock that you want on your radar in the coming weeks. So ultimately, NVIDIA ended up as a bank it stock for us today. So that's all I have for my video today. Don't forget to click subscribe so that we don't miss out on any of my upcoming Bank It or Tank It videos. And be sure to leave me a comment below this video or find me on Twitter at ChatShootGuru. Leave me a comment on there as well, and I'll be sure to get back to you, let you know my quick take on any of the stocks that you recommend, but also I'll add them to my list. That way I can feature your stock in an upcoming Bank It or Tank It video. So until next time, I'm Chad Shoop.